right, good morning, traders. This is Blake Morrow. You are listening to the Morning Edge webinar, and I want to welcome you all back. Today we have a really exciting guest, and I'm glad I can actually be here to host today's session. And we have a gentleman by the name of Joe Acevedo, and I hope I pronounce his last name correctly. Whenever you pronounce somebody's last name for the very first time, I mean, I can read it and just assume that that's what it is, but when I say it, I'm probably better off just saying Trading Points. So let's go ahead and grab Joe here and say hello to him, and let me make sure I can find him really quick. And where did he go? Let's see. Give me 1 second. There he is. All right. Joe, can you hear me?
Yes, I can.
Hey, Joe. Good morning.
Good morning.
Hey, no, I mispronounced your last name.
That's okay.
Say it for me.
Acevedo.
Acevedo. Wow, you're a man of mystery. Joe, I want to welcome you to the Morning Edge, and if I'm not mistaken, this is probably the first time anybody's heard your voice, aside from a few select people.
That's true. That's true. Witness protection works phenomenally well.
Well, first of all, I want to welcome you, and I'm so happy to have you here. You and I have had a very how should I say, fruitful relationship over the years. I guess that's a way I can explain our relationship over the years via
that other malcontent, Kevin Ferry. Yes.
Yes, exactly. With Kevin, and actually you have, and here, let me grab your profile so everybody knows exactly who you are here. Most people know you through Twitter, and they know that most people know that you've worked with Kevin Ferry over the years, with the Hooper Quant models and whatnot. But you yourself, I mean, you trade very actively in the markets, and you're very interactive on Twitter. And in my opinion, I've always found the information that you put out extremely valuable. Especially to what I do, and I know it's not all currencies, and you tend to trade a lot of futures and S&P, but the information that you put out and the charts you put out really have helped me over the years, and I know we've had actually a really nice relationship over the last several years. I've enjoyed following you and interacting with you. And so I want to thank you for taking the time to being on the Morning Edge and being on our webinar.
Thanks for having me. This is fun.
Yeah. So now, could you not do me a favor, do everybody a favor, and tell everybody a little bit about yourself and what you do, how you got here, just kind of some history.
Sure. I've always been a fan of the markets. One of my early memories is going to the local candy store and picking up a Wall Street Journal for 15 cents. Purchased my first stock, Mattel, and my second stock was STP, because we were all fans of Le Mans. That was the big movie that came out that year. And we'd go off on our bikes and we'd get all these stickers at gas stations. So I always loved just the statistics and just looking at it, and said this was a lot of fun. And so fast forward many years later, my very first job was at Standard & Poor's. I started in the mailrooms in the summers in high school, and stayed there a good amount of time. And eventually I went to Dow Jones and was there a good amount of years. And I always knew that I would trade. I just knew it back then, and I'd always do it for myself, and I've been doing this for about 10 years now.
That's awesome. And it's so funny when you said STP. One of my childhood friends growing up, his father, and I remember when they actually moved away to San Diego when I was like 14 or so, but his father was an STP representative, and we used to have STP stickers all over the
Oh
place.
yeah,
Anyway, anyway, so you've been trading the markets for the last 10 years or so. Now, how'd you come
well,
across
full time
full
before
time?
that
Okay,
was part time,
okay,
and did horribly as anyone would. Um, Blew up a couple times when I was trading it part time, and thankfully it was small then, but it's the tuition that everyone pays, and
everyone pays.
without question, we all go in thinking, oh yeah, I'll do better than so and so and whatnot, and I've learned and I can paper trade, but it's not. It's very much the Mike Tyson rule. You get in, you have this great system, that either you've purchased or subscribed to, and the whipsaws just start hitting you. And
Yeah.
how you handle that is how you will progress.
And that's a really good point that you bring there. It's how you handle it and how you bounce back. And one of the, I guess, characteristics that I always see from successful traders are how well they can bounce back from incurring losses and setbacks. And it's really how you bounce back is how it's going to be the way that defines you as a trader. So that's
Tom Harrison from Minionville had this great saying: "A good trader knows how to win. A great trader knows how to take a loss." And I find that so true.
yeah. Very, very true. So now tell us a little bit about, because I know you and I had talked previously, and I said, what's funny is when we'd bring on Kevin Ferry. I mean, I love Kevin, boy, I tell you, and that guy's probably one of the most the one of the best minds that I've met in the markets, and I don't, you might have heard me say this about Kevin during his previous interviews, and I know you've listened into a few of them. I mean, I would be on my way to the studio, because we had our own studio where we broadcast the Morning Edge actually used to be broadcasted via a green screen, monitor, or cameras. We had two cameras, a camera crew, line. It was just like CNBC. We had our own hosts or
Yeah,
hostess,
I've seen
and
some cool pictures.
yeah, and so I'd be on my way to the studios, and I'd hear Kevin in the morning. He'd pop on CNBC, and I'd actually stop on the road, pull over, listen to him, make any notes that he said, because he was like one of the very few people that I actually thought knew anything about anything on CNBC. And so when I heard him, I'd actually listen to him. And so it was such a pleasure to A, meet him in person, B, have him on as as a guest. But he is one of those people that if you're not following him tick for tick, tat for tat, you could get lost.
I still
And so
yeah.
yeah, okay. So tell us a little bit about your relationship with Kevin, and how that came to be.
It was actually through Twitter, and we would be bumping into each other at different levels, and I noticed his work, and he noticed my work, and we just started up a conversation, and it was a handshake deal, a virtual handshake deal, because we've never met in person, and meaning to, but it just didn't, and so we've talked so many times. I love his work, and he understood what I was doing, that I'm not a chartist. My charts are an expression of my model, as he is not a chartist. He has this model, he has this point of view, and he trades that. And it just meshed.
Wow. So you guys had never even met in person.
No.
That's crazy.
Is that
That's
crazy?
crazy. That is crazy. So I got a chance to meet Kevin before you did. It's crazy.
Yes, you have.
Right?
Yes,
You
you
should have
have.
came. You should have came to
Well,
Dallas.
The government doesn't allow me to leave the state. So
That's that happens when you're in witness protection. All right, got it. So tell us a little bit about how you trade and what you trade.
I mostly trade the S&Ps, the bonds, and crude, NQs. I pretty much stay away from the agriculturals and the softs and currencies. Um, I just find I have a good rhythm with the instruments that I of the S&P, the NQs, the 30-year, the 5-year especially, and crude. And sometimes you just have to stick with what works for you. I really don't trade the ETFs. I don't trade options, and it's been working for me.
Oh, okay. Now, and to me that makes a lot of sense. I'm with you. I get people that try to convince me to trade one asset class or the other, and I'm just like, listen, I trade what I'm comfortable with, and which these days is predominantly currencies, and I get it. So when I know you and I always have conversations about currencies, and if I'm talking about the yen, you're sometimes referencing the yen futures, and I'm
Oh,
I'm actually looking at the spot market.
it's a running joke, but it is yeah.
It's like I almost have to sometimes feel, all right, Joe, let's imagine a teeter-totter. If one goes up, the other one goes down, and then I end up laughing about it with you. So now you use it
Well,
from
it's
go
like
ahead.
that with bonds. I think there are people that have like $19.95 newsletters that don't understand the inverse relationship between price and yield.
Yeah, right. That's a very, very good point. And they really don't. And that was, believe it or not, when I went and got my Series 7 back in 1995, I think that was one of the biggest problems or one of the biggest struggles that I had is understanding yield and price.
Yes.
I didn't get it. It didn't resonate.
But it's like that with me with the inverse currencies, I like to call them, because the Merc, uh, has the futures, and I know how to trade those with the currencies. Not well, but I do. And the spot, when it's opposite, like the Canadian dollar or the yen, people say they're bullish or bearish. I still, to this day, scratch my head. What do they mean?
Yeah, right. It's so funny when I get the direct message from you and you're like, so are you buying yen or are you selling yen? I'm like, ah, and as I'm ripping hair out from my skull.
I have that
So,
confused. But anyway, with Kevin and the Hooper model, uh, it was great. Now, I don't have a financial interest in anything. I'm just going to tell you about things that I like, I enjoy, I do. But with the Hooper model, it is price only. It's based on just what's happening um, with price. And it doesn't care about the charts. It doesn't care about moving averages. It doesn't care about the VIX. It's boiled down to this terrific model. And originally got its start with um, as a mean reversion model. And partners of his did swimmingly well with it until 2008. And the volatility was such that it just did that person in. And Kevin, to his credit, he just turned the model on its ear. What became a mean reversion became a trend following system. So with what I do, and I follow Carolyn Baroden with Fibonacci trading, and the missing piece was really uh, Kevin's confidence in this model. And that's it. I mean, there are many models out there. There are many approaches to the market. But if you have confidence in what you're trading, you will do well. If you
yeah,
don't, if you second guess, if you wait, if you just want that a little bit more confirmation, what happens is you're not getting an optimal entry. Your risk reward uh, does not improve. your losses, potential losses, your stop losses get farther away. All of these are not good things for a day trader like myself.
Right, right. That makes a lot of sense.
Is that too long?
So yeah, no, so when you're dealing with the models like Kevin's doing, it's more of a confirmation tool when you complement it with some of the technicals you're looking at. Is that correct?
That's correct. I mean, what I like to do is start from large scale weekly and then drill down. Because the idea is get the bigger trend right and then trade the smaller time frames to time that entry. So I'll never catch a top or bottom. What I want is to get that first retrace, that second retrace, those movements back to symmetry. And when you do that consistently, it is a good way to trade for me.
Yeah, and Joe, it's one of those things that I've been teaching retail traders for, I want to say this is my 13th, 14th year of really, teaching people how to trade. And one thing that I continuously find is traders, especially the newer ones, are so dead set on trying to find the low or the high that they tend to forget that the majority of the money is made in the meat of the trade or in the trend. If you can just identify the trend and keep trading with the trend,
Yeah, I have to
that's
say that
what money is made.
that point was saying, there are many people out there with Uzis. Picture yourself as a person with a pea shooter. You want to be on the side of the people with the Uzis, not against them. And in that vein, you want to be with the trend. It's very difficult to counter trend trade. I can't do it.
Yeah, it takes a certain skill, and there are there are certain methodologies that can help you trade counter trend, but really, the mainstay of what you're looking for anyway is to trade in the direction of the trend, and using some of these levels, maybe complementing with the Hooper Quant model to help you find those levels. Now, would you, and I know you've prepared some, but would you like to show some charts of how exactly you look? See, now I just pushed you into, look, we're going to show trading on multiple time frames. You see how that works, Joe?
See
See how I
how that
led you
works.
this?
That's good.
See how I led you that way? That was pretty
I'm
good.
ready. I am able, but maybe I choose not to.
All right. Well, let me see if I can. I'm going to go ahead and find you again, and I'm going to make you presenter. So just give me 1 second. Of course, just soon, there we go. All right. So let me go ahead, and I'm going to make you presenter, and so you're going to see. You're going to see the prompt that tells you to show a screen, and I'm going to show you what screen I see.
I'm looking at screen one.
I'll tell you exactly what I'm seeing here in a moment. Okay, I'm seeing your E-minis, and I see a 15-minute chart and a 60-minute chart. And
Right.
then I also see your email, and I see a little post-it note too.
Yes, great.
Okay, cool.
This is sort of what I post every morning, just a snapshot of what's happening with the S&P futures. And what I like to do is look at the 15-minute, 60-minute, 240-minute, and daily. And I learned that 240-minute trick from currency traders. And the idea behind it was picture the world before there was 24-hour trading and Globex and whatnot. The 240-minute, to me, is so important. It really equates to what old-timers used as the hourly. And I think that's why it's important to always look at that 240-minute. So that's just my view on what time frames I use to trade.
Awesome. And I love the quote, by the way.
It is almost true, yes.
It almost happened.
So actually, what I'd like to do is start with the SPY, and I'm going to show you what it looks like on a huge time frame. Okay. The really big picture is this one right here that I'm posting up here on a monthly. Now, I don't trade the monthly, but I just thought it was really important just to look at.
Yeah, sure.
To me, and people argue this, it's a double top going back to 2000, whatnot. It's, to me, let's just say for argument's sake, a bull market started in the bottom of 2009 in March. That to me is the start of a new bull market. People may argue differently, but you know what? It's been several years, and I don't know how many points. That's a bull market to me. So I take tricks from short-time traders, where let's look at price extensions. Let's look at fib relationships. And if you look at the height of the market in 2007 to the bottom of 2009, and you project that out in the future, the height of the market was a fib 1.618 extension. And the market stalled and is coming off of that. So it is not crazy to use short-term strategies to look at the market long-term. So that's the thesis that we're pretty much extended on a monthly basis. And then you have some retraces and whatnot, and you look at the major retraces that we've had, 17%, 21%, and now the current one is around 15%. What I think is different about this decline versus other declines is that the weekly trend has finally flipped, and I'll show you that in the weekly SPY. Now, this is the first weekly flip.
No, explain to me a flip.
I'm sorry. Well, there's a way to measure a trend, right? Some people use parabolic SARs. Some people use moving averages. I like to use it's an average true range trailing stop. It was taught to me by Harry, who goes by the current moniker in Twitter, the ATR man.
Oh, yeah.
He changes it a lot.
He's a great bond trader.
He is phenomenal.
And I didn't know
it would be him.
I didn't know his first name until you had mentioned it when we talked.
Yeah, he had DeBrink for the longest time, and just changed it over to this. But he is the be and end all in understanding the ATR. I'm just going to put this posted up here, and this is the article if you're interested in the ATR. And it's not the average true range that most people look at. If people are Googling, Investopedia, this is the average true range trailing stop, and the author is Sylvain Vervoet. And you can find it. You can Google it. Stocks and Commodities magazine. There are ways to get this into TradeStation, eSignal, etc. But that's what I'm talking about when I look at average true range. When I determined what the trend is, when I say the 30-minute trend is such and such, or the 60-minute is such and such, to me, the weekly trend finally turned bearish early August, and you see that here, and then confirmed. It closed below the trend several weeks ago here on this arrow here. So when you have that daily trend, the weekly trend, everything else is colored with that the high is behind you. And I trade with that confidence, knowing that we've seen the high, and now everything we're doing is retraces to that, and however you measure it. What I try to do is stay on the right side of the 30-minute on how I trade. But if you were a longer-term trader, you would look at dailies, you would look at weeklies. What I find is that a lot of people try to trade a position and daily or a day trade, and it's very difficult to do. It's that sweet spot of swing trades, I think, is very, very hard. And I tried to do it many times, and it just didn't work for me. So I either have to be a long-term position or a day trader.
Makes sense.
Okay. So I'll do a workup on this, and I occasionally post this on what the weekly trend is. And once I do that, then I'll drill down. I'll drill down to daily, 240-minute, 60-minute, 15-minute, and then I'll trade from that. So that's the approach that I take. Very different from what Prechter does, or these fractal people, where they think that the market is fractal to the smallest degree, and then that relationship holds through all time frames. In theory, yes. In practice, no. How do I know that? Well, I've worked on enough models, and even with the Hooper model, that the model works up to a certain point. And if you get below, let's just say 60-minute with Elliott Wave, or below daily with the Hooper model, or whatever you pick, it breaks down. The conventions that we think that there can't be triple tops, triple bottoms, quadruple this, that all goes away when you're down in the 5-minute, 15-minute time frame. What you need there is the confidence that you have an approach and you have a model, you're looking at clusters of fibs, whatever. And when you do that, and you've done it enough, and you've been burned enough, you realize that markets are not infinitely fractal. In theory, yes. In practice, no.
Great point.
So, did you want me to go with how I look at the S&P?
That would be great.
Okay, so that's a weekly, and I that's nice to post on a Friday, and it just is fun to look at, and it's a good argument point.
So now you're going to take us into like the daily time frame.
Yeah.
Okay.
And usually I'll have all four time frames up on my multiple screenshot, but
of course
we're limited to one screen, and I'm going to show you now the daily and the 240-minute. Now the daily has a nice cluster of fib resistance here, 1970 to 1988. You've had a stellar move from this 1800 area, and what I consider this is huge A wave down. This is a B wave corrective move up, and I'm expecting a C wave down into this area. That's my Elliott wave of my knowledge. And let me say that I only believe half of what DeMark tells me, half of what Elliott Wave tells me, a lot of what Hooper tells me, but I try to stay on the right side of the 30-minute trend and stay on the right side of Hooper. And if
are you a DeMark follower?
No, I've recreated his stuff, and I don't think that many people know that DeMark did his studies because he wanted to quantify Elliott Wave. So I find it humorous that all these hedge funds poo-poo the idea of Elliott Wave, but they embrace DeMark as this objective me plus ultra of,
Do you know what that do you know what that means? He's a really good marketer.
yeah.
That's
But if people want to do it themselves and they want to do it for a few instruments, it's not a trivial task, but it is straightforward. And this book here, DeMark Indicators from Bloomberg Press by Jason Pearl, is a great place to save yourself $500 a month and do the indicators and the camouflage studies, the reference studies, all that stuff is in there.
got it.
And it's a great book. It's not. It needed a good editor, but it's all in there. DeMark's books do not have that level of granularity or clearness of instruction set on how to recreate it in Excel. So that's my $25 tip for you, is the DeMark Indicators, Bloomberg Press, Jason Pearl, if you're really interested in recreating those indicators.
That's good. I haven't met him, but his support office was upstairs from my old office here in Phoenix, and so I met his daughter and a few people that work there and stuff. And I never got a chance to meet Tom since he worked predominantly from home. So
Okay. And
yeah,
he's near you, like you're like neighbors, right?
yeah, we're real close. He's like literally like 2 miles down the road. Yeah.
That's great.
Yeah, yeah. So I'm gonna go bug him one of these days. I'm gonna tell him, hey, look what Joe found. Just kidding.
He actually
No,
looking forward to this book, and he does change the indicators to make it more relevant to subscribe to his $500 a month service. But you can get awfully close. In fact, I think spot on with this book and the indicators.
yeah. All right, continue on. I didn't mean to interrupt you there.
It's good. I'm glad you did. So let me just take this down here. I'll look at the daily and I'll create clusters of resistance and we'll look at extensions. My favorite extension is a 1.272 extension, but the idea is, there are many fibs. You can create fibs from any level. What you have to do is be consistent and try to recreate the levels of resistance from the high point, and take one from here, take one from here, take one from here, take one from here, and then you'll get an idea of where the cluster of daily resistance lies. When you find that this breaks, it'll travel to the next trend resistance level or a larger fib resistance. To me, once it goes past 61.8%, 78.6% is magic. And, people have pointed out Lucas numbers and all these odd relationships. I'm a little bit simpler, and I just keep it to, 61.8, 38.2, 50% retrace, which is not a fib. I had an argument on Twitter about that, which is great. Put them all together. You get a cluster. You trade on a smaller time frame against that cluster. Now, I was talking yesterday to Nick Trades.
Uh-huh.
And I had posted this earlier in the day. Maybe that's not it. Okay, mistake number one.
That's all right. Forgiven.
Okay, here we go.
There we go.
This is what it started to look like when things were breaking down yesterday. And I had mentioned to Nick, I think this. This is what I had posted earlier in the day. I had this harebrained idea that this looked like an ABC corrective move up in the morning, and I just felt that we were going to come back down into this area in the afternoon. And it was a partly baked idea, and that's the thing. You just throw it out. What you do is you trade smaller time frames against these anticipated levels of resistance and hopefully get a few points in the way. You know, several contracts, a few contracts, you get a few points, it's better than a stick in the eye. And that was the idea. Well, lo and behold, the market does come up to this ABC small corrective move up. Here's your A, here's your B, which is around a 61.8% retrace, and then back up. And that was the high for the day. Then the market goes down. Boom. Right? It falls into this cluster of support around the 1875 area, which we had looked before, but a little further. You had a cluster of support there with the fibs, and what you do at that point is, okay, well, how do I trade that? Because there are so many fibs, there are so many lines. What do I choose? Find a cluster that has 3 or more fib relationships, and then look at a smaller time frame. Now, how do you define that trend? You could define it on a 1 minute, 2 minute, 5 minute, which I think is a little further along than what I do. I take a look at it. I don't know if I'm pronouncing this correctly, but it's Heiken Eishi. It's a Japanese way of looking at a trend. And what I do is, like, the first green or the first blue bar, you're in. So you've identified this larger time frame of support.
Support, yeah.
And then you look at a tick chart. The first time that it turns blue, jump on it. Going to take a little heat. More often than not, you'll be fine. But what's neat about this is, once it closes below 1650, or, you know, maybe you'd rather have it the 61.8% fib. Whatever it is, you've got a couple point risk and a several point potential gain. And it did. It moved sharply, several points. But since the larger trend is down, the 30-minute trend is down, the only thing backstopping you is 1650. When that gave way later in the day, you saw what happened today and overnight. I mean,
right.
It just fell apart. And that's the key. When you look at multiple clusters of fibs, either as resistance or support, you've got a level to lean against, and you be religious about taking your stop or taking partials and playing it out. And that's really what I try to do all day.
That's great, and you know, you take the fib clustering right out from Carolyn's handbook, right?
Yeah, Carolyn Barone really taught me how to do this. I was in her not her seminar, but her chat room for a few years, and I really took it to heart on how to learn how to do it. Mainly because she threatened, say, I'm not going to be here forever. So I sort of picked up on the hint that she's not going to do it forever, and I've got to really learn how to do it myself. She made it easier for me and everyone else in her book, How to Master the Time and Price Advantage, Fibonacci Trading. It's available on Amazon. It's inexpensive. It is a Bible on how to trade smaller time frames against, you know, the larger fib clusters and whatever you're looking at. And this applies to whether you're looking at weeklies and you want to trade it on the hourlies, whether you're looking at the 15-minute and you want to trade it on the tick. The principles are the same.
That's great, and you know, not a lot of people know this. I traded side by side next to her for several weeks back in 1996, 97. So that's where a lot of our you know, when Joe and I were talking, we realized a lot of our similarities stem from there, from working with Carolyn.
Yeah. Before I worked and did this type of trading, I used to do what everyone else did and looked at, like, Linda, I don't know if I'm saying her name correctly, Linda Bradford Rashke, and Lawrence Connors. And they had
Hmm.
put out this book called Street Smarts, High Probability Short-Term Strategies. And in it, it was a recipe book that you could replicate in Excel to put all these formulas together. And I broke them down into three types of signals: range breakout, trend continuation, and directional bias. And that sort of gives you the framework each day uh, on what the market is going to do. Is it going to be range bound? What's going to set it apart to make it a trend continuation? Is it going to reverse? You know, directional bias means the trend keeps going. Range breakout, fabulous. And it's classic. It's, you've had an inside day, the range is narrowing, it pops. Does it matter? Not really. High, low, takes it out, it tends to trend in that direction for the balance of the day. And I started out doing that and was moderately successful, but I always keep it in the back of my mind, and I lean on it occasionally, and I should look at it more than I do. So that is something that's available free, or you can do it yourself at Kevin's site, thecontrariancorner.com. This type of stats is there, posted every day.
That's awesome.
And I do it myself. I think that's a great place to start. There's a little page I put together on there. Scott handles it now, not me, but on what all these individual signals mean. And I find that useful. I find Carolyn's stuff useful. But I guess the big point is that I don't believe in anything 100%. I discount DeMark. I discount Elliott Wave. I'm not that religious about it. I think they're good frameworks of looking at the market, but to me, it's what Harry taught me: stay on the right side of the 30-minute trend, stay on the right side of Hooper with Kevin, and then you'll be profitable.
And mind your fibs.
Yeah, but again, the fibs are everywhere. What you're looking for is a tight cluster that you could lean against either in a counter trend or as a target. And that is what I look to do every day. And I redraw these charts and redraw them all day. And that's my idea of fun.
And that's, boy, you must be fun to hang out with on the weekends, bud. Hey, no.
Weekends. I live for the weekday. Who says that?
Oh, that's so great. Hey, Joe, we got. Thank you very much, by the way, for taking us through the multiple time frames, because I think breaking that down was extremely helpful to everybody. I want to take the next 10 minutes, if you don't mind, answering a couple questions. Can you do that?
Sure.
All
yes.
right.
And actually, before you start,
Yes.
these people I love. There's the obligatory ones that I have to put up here. Shameless, good trade, good SAR, don't
Thanks,
don't
man.
talk to me anymore. But here are people that I found useful and are phenomenal at what they do. Um, you know, when you can understand what Kevin's saying, it's unbelievable. This guy, Mark making sense, is one of the better macro guys that actually understands micro and you can apply it for trading. For Elliott Waves, OEW Tony, Morrison Markets for agriculturals, Helen Meisler for indicators and sentiment, Phil Zucchi for DeMark. Unquestionably great. Marked out is just too smart to live. Macro issues, go to him. And the guy who taught me or thought that I could make myself a trader and really believe in myself is Don Miller. The guy is beyond great. And so he doesn't post much now. He has a great site, but he is terrific.
Cool. All right. I'm gonna follow a couple of those that I didn't have don't have on my list myself. And Kevin, though, he keeps his he keeps his pretty pretty select though. So
Yeah.
if you guys, that's why you guys need to follow Joe. If you can't follow Hooper Quant, follow Joe because Joe retweets a lot of his stuff.
Yes, I am his spam filter.
You are his spam filter for sure. All right, so do you mind answering a couple questions?
No.
Okay, so JR says, Joe, sexy accent, where's it from?
Thank you. Thank you.
Also, what do you think of gold here? Now, by the way, gold's ripping, and it's breaking all sorts of resistance this morning. If
You
you
want to
guys
see
haven't
gold?
been watching.
Yeah, I have gold up here. You can keep asking your questions. I'll just throw gold up here and gold spot. There we go.
And George, by the way, says Joe Trading Points is one of the best Twitter accounts out there.
Yeah, thank you, thank you. This is what we look at in the short term. Right now, there is no reason to counter trend trade this. It's early in the game. Bearish on the 1215, on the 240 minute, bearish on the 1192. It just basically broke out of the 240 minute range. Here's the daily. Everything's pointing up.
Right.
This is what I do on every time frame. Start from the large, trend down. If you get caught on the wrong side of the 30-minute trade, you are hating life. I've been there. I've been there with the degenerate currencies. It is not a place you want to be. At least have something behind you, 15-minute, 30-minute, 60-minute, if you're going to counter trend trade, because you need a level other than this is too painful to trade with.
Okay. And I mean, you see it bullish on pretty much every time frame, and so do I. By the way, there's a big cup and handle that's been trying to play out, and I think it's been holding up very, very well.
Yeah, I mean, Cooper is bullish on the spot above 1245. People think maybe it's extended now. If it gets up and over, that thing could run to 13.
Awesome. Daryl, who's from New York, he says, "Are you from Long Island? I knew a girl going to school there with the same last name." And Daryl, I believe, is a little younger. So.
No, I am not. I am not from Long Island.
Okay. All right. I know you're from New Jersey, correct?
Yes, I was born in New York, but I live in New Jersey.
Got it. Let's see. JR says, Joe, do you prefer gin in the morning?
After March 22nd.
Patrick G, which you probably know him from Twitter, he says, can Mr. Trading Points please explain the 15-minute ATR and how he uses it to support the quant models? I think you did that already.
I think I did.
Yeah, you did. And he says, you do have a sexy voice, too.
Thank you. But let me remind people, first of all, I would like to make one thing quite clear. I never explain anything.
All right, now, Brazil 61. Chris Bear says, hey Blake and Joe, what is the action if you miss your entry? Let's say the market has already moved 110% ATR, for example.
What would I do? I think I would just look at something else and look for a retrace and look for smaller objectives. Remember, if you miss your entry, and there are very few places to do business, if you miss that, every minute, every number that you're looking for some type of confirmation to get in takes you away from your optimal entry and just decreases your risk. I mean, increases your risk, decreases your reward. So, yes, can you go for the last few points that happen to be the Hooper objective or the Fib cluster? Yes, you can, but remember, it comes with increased risk.
And I think that's the way I would look at it too. Well, I mean, I just try to preach to people. I just don't chase. If I miss something, I missed it. And,
there's always going to be an opportunity. You know what?
Yeah.
In the ES, maybe the bonds coming your way. That they're coming back. And you trade the 5-year. And maybe you trade that a little heavier if you think that the market's going to do something.
Right, right. Okay. Hey, so I got a question from Chinton. Says, Joe, how do you calculate those pivots? Do you calculate it by your own method, or do you use any default indicator for the pivots?
I use the standard floor pivots. You can find them. There's guys that there's sites out there that could, that there's several variations. Just use the plain vanilla pivots. You
Sounds
can find
good.
them on Investopedia. Everyone has them, and there's no magic to that.
And Patrick G says only a degenerate gambler would use Japanese Heikin-Ashi indicators.
That is true.
Let's see. Qatar says for staying on the right side of the trend on a 30-minute chart, what moving averages would be the most suitable? Thanks.
I think you need to find something that suits your time frame and your risk tolerance. I think what people really need to look at is probably moving averages on a smaller time frame, and I would suggest using 8, 13, 34. I fit, obviously, and it's not an accident that they work well. But what's really neat is if you can get the moving averages to confirm when they're both turning up or turning down. If they're meaning that they're pointing in the same way, there's a good probability of a continuation of a trend move. And Carolyn speaks volumes about symmetry, returns back to symmetry, equal point moves back and forth. It's in her book, and that would be most helpful if you're looking to trend trade. Make sense?
Awesome.
Okay.
That does. That really does. Rob asks, are those red and blue lines the ATR trailing? I think you're talking about
these lines here? No, this is something I shamelessly reverse engineered from Phil Erlinger. They're nonlinear, and it gives you a good idea of they're not Bollinger Bands at all, but it gives you an idea of the strength of the trend. And for instance, when it breaks under the red on the higher time frame, it really, or it breaks above, I guess, in this gold, you see the strength of the trend.
Yeah.
And you see what happens when there's a area of congestion, it comes back down, doesn't quite break the lower band, and goes back up. I love just looking at this because it's nonlinear. I'm not a trend line guy.
Got it. Okay, very good. Nick trades, who's listening in. She says, great show today. Hey, Joe, what do you think next for crude oil?
I think we've seen a lot.
Really?
I think sentiment has gotten too dark. I think this thing trades back up.
Wow. Well, there you go. And so, and I think she shares the same view as you. Actually, when she was on here last week, she was looking for higher levels, and rightly, actually, since our webinar, she was looking for, I think 38 is what, if I remember correctly. My memory may be off since I was sick for the last several days, but she was looking for a little higher levels in crude. So that's good.
I mean, she's expert at looking at daily sentiment index, and Morrison on the markets, Ken Morrison, just drummed it into my head. You do not want to be short a market that is single digits DSI. I don't subscribe to the service, but it really, it really, you need to be careful when it's at 90 plus. You don't want to be long it, and when it's when it's 90 plus, you don't want to be short it, right, or something like that. I don't know. I'm all confused. Anyway, single digits DSI is very dangerous to short.
Got it. Hey Joe, what I'm gonna do is I'm gonna be taking over the screen right now. We've got about 1 minute left. I just wanna say thank you so much for being here today. One last comment.
I'm sorry. It was terrific. I'm trailing off in my thought process here.
No, and for those of you that don't follow Joe, he's at Trading Points on Twitter. You can also find him on the Contrarian Corner. Do you still post there daily?
No, I do not.
Oh, you don't? Okay.
That's Scott's thing. I'm not involved with Kevin's website anymore.
Okay. All right. So
Still very friendly, but
your email address is Joe
Joe at TradingPoints.org.
tradingpoints.org. So
Yep.
Joe at tradingpoints.org. I'm going to put your email address. I'm going to put it in the chat box if anybody wants to get a hold of Joe. He's awesome. After this interview, I think people will realize that you're actually approachable, Joe.
Ha!
Not the man of mystery anymore. No, I really want to thank you for such an insightful interview. It's been great. I've enjoyed my time speaking with you, and I know that I'll have you on again if you will bless us with your.
I'll be more organized next time.
Oh man,
Sure, by
you're
the way,
very
guys.
very organized. So I think Kip's here too. Kip, are you there?
Yep, I
Kip,
am
you
here.
want to say hi to Joe?
Hey, Joe. Good morning. Enjoyed listening. Thank you
Hi.
very much.
Thank you.
Well, Joe, thank you so much for being here, and I'll catch you on the flip side in Twitter sphere.
Okay, great. Hope you
All
feel
right.
better.
Thank you. Appreciate it, Joe.
All right.
Have a great one.
You too. Bye-bye now.
Bye-bye. And good morning, Kip.
Good morning, Blaker.
How are you doing?
I'm good. The question is, how are you doing?